Okay, so this is clip number 3 on chapter 18 in your textbook on fractional reserve banking. And just to remind you, this is all coming out of pages 598 to 600 in your textbook. They have a picture in there, one of the figures in that area, and I'm just basically elaborating on it to sort of explain why this all exists and sort of the more of the mechanics behind it all. So now that we've covered all, remember, let's just quickly recap. The key terms again that we need to remember are currency, which is that paper money stuff, reserves, which are assets of private banks, okay, like Royal Bank, TD Bank, whatever, and so they're owned by the private banks, and they're deposited at the central bank, so they become a liability. Currency plus reserves, which are both liabilities of the central bank, together form that high-powered money, that monetary base. And what's the other term? Central bank money, yes. Okay. All right. Deposits then are when private people or private companies, right, like me or General Motors or whatever, make deposits. They put deposits into basically a checking account, and so at a private bank, right, private commercial bank. This is like when you get your paycheck and it's deposited into your account. That is a deposit. It's an asset for you, and it is a liability for your commercial bank. The reserve ratio is the ratio of reserves divided by deposits. Okay? And this is normally some fraction, so it's going to turn out to be like 0.05 or something. Okay, so it's going to be less than 1, and usually pretty close to 0. Of course, unfortunately, if you get too close to 0, sometimes you can create problems for your bank. It can become riskier. Right? Higher reserve ratios usually make safer banks. Okay. Right. So this ratio is effectively like that. It's sort of like capturing, if you will, how much risk the commercial bank's taking on. Right? Because as I said, higher reserve ratios. So let's say 40% reserve ratio would be probably a much safer bank than one that has, let's say, a 1% reserve ratio. Okay. And then the last thing was this sort of currency divided by deposits. This sort of, I call it a cash ratio. It's sort of like a measure of sort of like the how private people they look at sort of their situation, and they say, well, how much of my money do I want to hold as deposits, and how much do I want to hold as cash, right? Because deposits, of course, are going to be in your bank account versus the actual pieces of paper, the cash. The other term I should have mentioned, so we did talk about monetary base, which is currency plus reserves. The other one is money supply. And money supply is basically a measure of how much money exists, supply, in the economy. And your textbook mentions all these different measures. It's all these, like, it's keeping all this, the statisticians employed, basically. Although they do serve useful purposes. I'm being a little bit sarcastic. But, and they call these things like M1 and M2 and M3. And it's just how they define what is money, what is not money. It's just a classification system, basically. M1 is what they call very narrow money, and then M3 is more of a broad money. What that just means is broad just means they include more things in the calculation. Narrow just means they include fewer things in the calculation. So normally you would expect the M1 to be the smallest and M3 to be the biggest, because M3 they're adding more things. and an M1, which is the narrower one, they're only adding really 2 things, and so it'll be smaller then, right? Because you're adding fewer things, and all the numbers are positive, right? Because we're talking about money. At some point, you usually don't have negative money, right? You don't walk around with negative $20 bills. They're all positive $20 bills. You know, so this is all positive numbers. So we're gonna, when I talk about money supply, I'm basically meaning a very narrow measure of money supply. Okay, and in particular, what I mean is the currency that the public holds, plus all the checkable deposits, those deposits they have, because people can write checks on them, so they're basically money as well. So currency plus deposits, right? And think about what this means. Who holds all the currency? Well, private citizens hold the currency, right? I have currency, you have currency, and I have a checking account, and most of you have checking accounts. So it's basically all the money that the private people and private businesses have. So it's currency plus deposits. That is what they generally, in a narrow sense, mean by money. Money supply. Okay, to be clear. So that's good. Okay, so let me try to explain what's going on here. Just so the three people in the 3 main players at stage 1 of this game. As I said, we have a central bank, we have a private bank, and we have some citizen. And the way this story goes is that the private citizen owns some sort of Canadian government bond. Okay, so this is a liability of the government of Canada, but it is an asset to our private citizen, because the private citizen is the one getting the interest payments every 6 months, and of course eventually the face value back in some far distant future. Okay, so an open market operation, which I'm going to describe, and I'll put it into the next video, so I can just talk it through to you, is basically the central bank is going to buy this bond from this private citizen. Okay. Now, to do that, of course, what ends up happening, of course, is that the bond goes from the private citizen and now becomes the property of the Bank of Canada, the central bank. Now, the central bank has to pay for this, and what it normally does is it does this all just through accounting entries. There's not what happens is the private citizen gets a check, if you like, from the central bank. So the central bank takes a piece of paper, writes down on it the amount of money, says, you know, please pay on demand Neil, you know, $1,000. Then I go to my bank and I deposit it. So that becomes an asset for me and a liability for the private commercial bank. Now, there's sort of an accounting problem here, because there needs to be an offsetting entry. And this is basically just how the central bank just creates money out of thin air. They just create, by the stroke of a pen, an additional reserve for the commercial bank. And I'm going to carry on in the next video clip about what this all means.